In the aftermath of the flash crash of a year ago, my next guest said that high-frequency traders were unfairly singled out by critics who he said had no evidence. Does he still feel that way? Joining me now is Manoj Narang, the CEO of high-frequency trading firm Tradeworx. Mr. Narang, welcome to Bottom Line. Thanks for coming in.
Thanks for having me.
Are the traders being unfairly singled out?
Well, they were. I think that the official post-mortem of May 6th came out with the SEC and the CFTC jointly weighing in on what occurred through a lot of forensic analysis and through a lot of data analysis. And it was pretty clear that high-frequency trading, according to the official account, had very little to do with the flash crash.
Well,
so,
interestingly enough, because the chairman of the SEC, Mary Schapiro, she was in Washington today. She was addressing the Investment Company Institute conference, and she had a quote that we found, and we want to put it up for our viewers because I thought it was very telling. Chairman Schapiro said, quote, "High-frequency traders turned what was a very down day for many investors into a very profitable one for themselves by taking liquidity rather than providing it." And she continued, "Their activity that day should cause us to thoroughly examine their current role." What's your reaction to her statement?
Well, I can only speak for myself. That was the worst day in the history of our trading operations for high-frequency trading, so I'm not quite sure what she's referring to there.
Do you believe then that more or less goes along the line of last year, maybe that high-frequency traders were being scapegoated because of this?
Yeah, I think that look, I think that to some extent she's contradicting what her agency's experts put out in terms of the official reckoning of what occurred.
What did your company do a year ago today? Did you turn machines off? What did you do?
We hit our stop loss, as the market was going down, and close to the time that it hit bottom. We turned our systems off. We missed out on a pretty profitable rebound. So I think that perhaps the people she's referring to who had large profits that day stayed in the market. They were perhaps better capitalized than us and could afford to stay in and take more risk. But to castigate them for staying in the market that whole time and then experiencing a rebound, I think is rather misguided.
At what point did you turn your machines back on?
We did not turn the high-frequency trading systems back on for the rest of the day.
You did not? So you resumed the next day?
We did. The next day was quite profitable.
Yeah, very much so. There have been critics, as you well know, of high-frequency traders. They say they can't put themselves in the same league as market makers because high-frequency traders can just turn their machines off. How do you respond to that criticism?
Well,
especially the part where people say that it might not be in the same league.
I'm not sure what it means being in the same league, but it is definitely true that high-frequency traders can turn their systems on or off. Generally, they do it in order to, enforce capital preservation to avoid going out of business. I think that there have been some, regulatory inquiries about whether it makes sense to enforce some obligations for people who engage in that sort of activity to stay in the market. But, there's absolutely no evidence that those sorts of obligations have any efficacy whatsoever. I mean, in fact, the corner of our market that does have obligations, namely the order flow internalization providers who execute the vast majority of retail equity orders, they, in fact, turned off just like high-frequency traders, despite the fact that they do have liquidity obligations and routed all their flow to the exchanges.
Well, one of the results of the flash crash was a reduction in volume. How does that reduction hurt high-frequency traders like yourself?
Well, I think it's a misunderstanding that the flash crash had anything to do with volumes. In fact, for several months right after the flash crash, we saw record high volumes. And those ended up being very prosperous times for high-frequency traders. Again, I can only speak for myself, and my firm is doing quite well. We're doing record volume in our high-frequency trading operations at present. But overall, in the industry, it's definitely true that volumes are lower. But it's partly an illusion. If you look at volume in terms of dollars, 2011 is actually higher than 2010, and 2010 is higher than 2009. So the market has really resumed its long-term secular growth.
Let me ask you about those circuit breakers that were put into effect last June. Are they enough to prevent another flash crash?
Well, the answer is yes and no. I wish I had a more clear-cut answer for you, but the reason why the answer is yes is that there was primary causes and primary effects in the flash crash, and then there were a whole host of secondary effects. The secondary effects I'm referring to are that a whole bunch of stocks, descended to ridiculous levels that you would only see if an asteroid were heading towards the Earth.
William O'Brien was telling us that too. Yeah.
And the actions taken by the regulators have, I think, done an effective job of preventing those kinds of secondary effects from occurring. But in my mind, those are by far the least important effects from the perspective of the stability of the market. The primary causes and the primary effects were largely unaddressed, and I think that's largely because of the SEC's obsessive focus on high-frequency trading and on market structure.
Why do you say it was obsessive, or is obsessive?
Well, the reason why the SEC's focus on market structure and on high-frequency trading is obsessive is because, again, high-frequency trading is not a threat to market stability. It is not a destabilizing force.
Well, is there a time when speed, even though this is what you do, but is there a time when speed can be counterproductive?
I think the key here is, as your previous guest pointed out, that all market participants use technology. High-frequency traders are perhaps the epitome of using technology in the markets, but all participants use technology, and the portions of the market that had technology failures last May 6th were not high-frequency traders. They were people, buy-side investor, large buy-side investor that was named in the SEC report, who was using a faulty algorithm to execute their trades. Yes, that's high-speed trading. Yes, that's algorithmic trading, but it's not high-frequency trading by any means. That algorithm was being used to execute a large buy-side hedging transaction. So that had a flaw. The other thing that was flawed was that, yes, it's a fair criticism that market makers disappeared and widened out their bid-ask spreads.
Right.
But the mere act of widening out your bid-ask spreads does not force prices to go anywhere. The reason why price is printed at absurdly low levels is because routing algorithms at the brokerage firms of the world routed to these so-called stub quotes. Okay, that's the flaw. That's where the technology glitch was.
Mr. Narang, I'm sorry, we're out of time, but I got to have you back because this is very complicated, and I don't think this short amount of time does it justice.
Sure.
But I'd like to have you come back at some point in the near future so we could discuss this a little further. Manoj Narang, the CEO of high-frequency trading firm Tradeworx. Sir, thanks so much. It was a pleasure meeting you. Thanks.